Hi everyone, it's Jack back with another video, and today I'm going to be talking about Visa, a stock that's well known to many, has a pretty much duopoly with MasterCard and the debit card business and payments transfers. A couple of other credit card players, but Visa is by far the largest and has a significant market share advantage over MasterCard. And that of course makes it a very popular stock and has been an incredible investment over the last, it's pretty much since it IPO'd. In the last year, it's actually not performed that well. Year to date, it's down around 8%, which is still better than the returns of the S&P 500, but less than impressive, really. Today, it's up around 5% on an earnings report that it released last night, and it's pretty good. A lot of positive insights into consumer spending. The stock still remains pretty expensive. It has a PE over 30, which traditionally has maintained a PE well over this in the past. Pays a 1% dividend. Its market cap right now is around $420 billion. And it's kind of right in the middle of its 52-week range. Makes it difficult to value it on the service. So we're going to go through the report, have a look at some valuation metrics, decide what we think of the company's future, and then look at DCF, and then work out what we think an intrinsic valuation and therefore a fair value is to pay. Like and subscribe if you're enjoying the video so far, and let's get into it. So first of all, what are the headlines? Net revenues, $7.8 billion US. That's up 19% year over year. GAAP net income up 10%, earnings per share up 13%. Really impressive numbers, broadly beating expectations across the board. Cross-border volume, excluding intra-Europe, was up 49%, which is a real bounce back from last year where it was relatively depressed. They've returned $2.9 billion of capital to shareholders in the forms of share repurchase and dividends. They authorised a new $12 billion share repurchase programme and increased the cash dividend by 20% to now 45 cents per share. Now this is not a lot, but it's quickly climbing up, and this has been a reliable dividend growth stock, if only paying a relatively small yield. Breaking down the revenue growth into sections, you can see the highest in nominal value reported revenue is the data processing revenues, which are up around 10%, followed by the service revenues, which are up 11%. But the lion's share of the growth for this quarter came from the international transaction revenues, which was up a staggering 52% to just shy of $3 billion. Absolutely really impressive growth. Of course, coming off a lower base because cross-border transactions were weakened in 2021, but this was a really big win for Visa, getting back to fighting form and securing strong revenue growth over the quarter. Other revenues up 13%, but this is really minor or long-term. Overall, gross revenues up 19% to $10.6 billion, and when you subtract for client incentives, that's the net revenue comes out about $7.8 billion, still up 19%. Next up is the payment volume figures, which of course are not only important for Visa, are important for the economy as a whole. Visa can be seen as a proxy for consumer spending, and in this quarter it was around 5% in nominal terms, 10% in constant currency terms. However, that really doesn't tell the full story. On the debit spending was up 0%, pretty much flat for the year, 4% on a constant currency basis, and credit card was up 11%, 17% on a constant currency basis. So debit card was the dragger here, but still fabulous numbers. 1.4, nearly $1.5 trillion in the US of total, roughly split between half credit, half debit. The same for international. And that a total payment volume of just shy of $3 trillion, $2.93 trillion. That is really an absolutely fabulous number, and it continues to grow year on year as Visa just keeps its secure market position. One of the most impressive things about this business is its margins. We'll look at it a bit deeper on in a second, but its free cash flow and net income margins are absolutely fantastic. They've recorded for the year so far just shy of $18 billion in free cash flow, which is a fabulous number on the revenue this company is doing. And for cash return to shareholders, they've returned around $3.2 billion of this so far this year in dividends, around $11.6 billion in share repurchase, leaving some to be reinvested in the business. But this, I think, is largely going to be the theme moving forward. They've announced another $12 billion in share repurchase. It's not really denting a $420 billion market cap, but over time, over many, many years, it's going to really dent the share price of this business. The stock-based compensation, not out of control by any means, and it's a nice dividend growth plan. I think it's an underrated aspect of Visa. It's its capital return to shareholders is fabulous, along with modest, sometimes not so modest, growth appreciation in the stock. Clearly this is a business that's performing well, it's rolling on all cylinders. I don't think I really need to espouse the benefits of a company like Visa to many people. It's a well-established name, people know why Visa is such a powerful stock. I want to have a look at the balance sheet and see if there's any red flags in it. And while it isn't the best balance sheet in the world, they have a cash-to-debt ratio of 0.73, which is actually pretty weak for Visa's history. This is not really that much to be concerned about, in my opinion. They have around $17 billion in cash, around $24 billion in debt. not the best balance sheet in the world, but a pretty stable one. It's a debt to EBITDA of 1.26, which I think is decent. Debt to equity of 0.67, which I think is okay, while not very good for Visa's historical comparisons. Their interest coverage is absolutely fabulous, 37.5, nearly 38, meaning they can pay off 37 years, nearly 38 years of interest with this year's EBIT. So the higher interest rates are not really a concern on this debt load. They have such free cash flow generative that they could have almost paid off all the debt this year with just the free cash flow. It's given an Altman score of 6, which I actually think is a little harsh. I think it's much stronger than this because of its free cash flow generation. They could pay off its debt pretty easily if it really wanted to, but it sees no reason to. It's clearly safe from near-term financial distress, in my opinion. Next, to do a little evaluation of Visa the stock rather than Visa the business. From a valuation point of view, it's actually trading at pretty reasonable levels compared to where it does historically. It's a PE ratio on a trailing basis of around 29.30 and a forward PE ratio around 23.5, 24. These are historically quite cheap for Visa. It's typically trades above 30. It always trades at a premium to the stock market. 1, because it's in a duopoly. 2, because it has been rising so well for so long. It's been a fantastic performer since IPO. And 3, because its net and gross margins are some of the most impressive you will ever see. 80% gross margin is fabulous, something you see very rarely outside of the software industry. 67% operating margin is absolutely outrageous. Some of the highest numbers you ever see. This is even strong for Visa's history. And a 52% net margin, meaning 52 cents of every dollar of revenue is straight in the back pocket. Incredible numbers. This is really the power of Visa as a stock, and why it will always trade at premium to the stock market unless it's losing growth, essentially, unless its revenue is going down. It's because of these absolutely fabulous gross and net margins. Return on equity percentage of 40% is again outstanding, and a long-term return on invested capital of around 23.5%, 24% is again outstanding. All these metrics means that Visa is going to trade at a premium to the S&P 500, which it is right now. A 4P ratio of 24 is a significant premium over the S&P 500, which is around 14 and 15. The price free cash flow of 26 is again not objectively cheap in my opinion, much lower than Visa's historical numbers, but that sort of price free cash flow is a bit above the 20 I would consider fair value. Of course, these more basic valuation metrics don't really tell the full story in many cases. I had to do a DCF to work out an intrinsic valuation based on the sum of its future cash flows. Now, personally, I don't believe that Visa can continue to grow its free cash flow at a rate of 18.8%, as it has done over the previous 10 years on an average basis. Even this year, it averaged nearly 30% free cash flow growth. I just don't believe that's sustainable over the long term. I think I'd figure much closer to 10 is more appropriate now. It's becoming a much more mature business, and it's fleshed out a lot of its easy growth, in my opinion. Its revenue growth has came down over the last few years. The last 5 years, it's averaged 11.2% revenue growth, and I think this is a sensible number going forward for a business to this size, scale, and maturity. So I'm going to imagine that free cash flow tracks with this. I'm going to assume 11.2% free cash flow growth rate. I believe this is a reasonably conservative number. If you believe more strongly in Visa, then you should input higher numbers in your calculations. This is broadly in line with Visa's expectations and analyst expectations. Using this 4% terminal stage growth value and a 9% discount rate for the long-term returns of the stock market, this gave a fair valuation of $154.62. That's compared with a present-day stock price of, well, actually that's wrong, it's around $203 as we speak because of the pop last night. And to me, that is just a little too high. Really, I would be happy by any means paying a slightly above fair value for a company, but we're talking a 25% margin of safety in the negative. This is a significant premium over the present day stock price, or a significant premium over its fair value. I feel like that is quite hard to justify right now. And that is really the summary and where this valuation ends for me, is the price is just a little too expensive for me right now. This is obviously a fantastic business that continues to return capital to shareholders at an excellent rate, is growing its dividend rapidly despite it being a relatively low yield, continues to produce strong revenue growth and has incredible gross margins and thoroughly deserves its premium. I just think it's a little too expensive. Basically a third over its fair value by my calculations, what I think are reasonably realistic, if not a little conservative calculations. I just think that is a bit too expensive of a price to pay. If Visa was close to its 52-week lows, I would be much happier, and I would likely invest actually if it was around 170 in the 180 range, because that I can kind of understand that sort of premium because of the safety of the ability to sleep at night with this business, because it's such a strong business, because it has well, it doesn't have a monopoly, it is in a duopoly essentially. And I can't see Visa really going anywhere. I think it's only on a path to $1 trillion stock. However, I'm just not really happy paying those sort of prices in this sort of stock market environment we have right now. But of course, I have to be proven wrong. And I believe that Visa will do well over the long run. Let me know what you think of Visa in the comments down below. Don't just listen to me. Do what you believe. Do your own research and due diligence, because I'm not a financial advisor. You shouldn't just do what I say. With that being said, like and subscribe and enjoy the video. I'll see you again next time.